Most Americans have no idea that a deal worth $500 billion was just signed, and it could quietly reshape your investment portfolio over the next 3 years. While Wall Street was obsessing over the Fed and interest rates, the US and India just struck the biggest trade framework in decades. And if your money is sitting only in the S&P 500 right now, you might be leaving serious gains on the table. Here is the uncomfortable truth. Most American investors are entirely US-centric. Your 401k, your Roth IRA, your brokerage account, probably 80 to 90% in domestic stocks. That worked brilliantly for the last decade. But the world is shifting, and the investors who see it early are the ones who benefit most. I will explain exactly what this trade deal means for your money, in plain English. No jargon, no politics, just the financial picture. Context. Here is quick context. For most of 2025, the US was hitting India with brutal tariffs, at one point as high as 50% on Indian goods entering America. That caused real damage to Indian exporters. It also slowed supply chains for US companies doing business there. Then in February 2026, that changed fast. Trump and Modi reached a framework deal. Tariffs on India dropped from 50% to 18%. The punitive 25% penalty tariff, gone entirely. And India committed to buying $500 billion of American energy, tech, and aircraft over 5 years. That is not a small deal. That is a structural realignment. And here's the part most people miss. The investment implications for ordinary Americans are enormous. Point 1. Indian stocks just got a major tailwind. When tariffs drop from 50 to 18%, Indian export companies, textiles, pharmaceuticals, IT services, gems, suddenly become significantly more competitive in the US market. Their margins improve, their revenues grow, their stock prices reflect that. India's economy is already the 5th largest in the world and growing at roughly 6 to 7% annually. That is nearly double the US growth rate. Actionable takeaway. Look at India-focused ETFs, tickers like INDA, the iShares MSCI India ETF, give you direct exposure to that growth inside your regular brokerage account. You do not need a special account. You just need to know it exists. Your Roth IRA could hold this today. Most people never consider it. Point 2. American tech and energy companies just won big. India committed to buying US energy products, GPUs, data center equipment, and aircraft. Think about who makes those things. American companies, US energy exporters, US semiconductor firms, US defense and aviation manufacturers. This is a direct revenue pipeline flowing into stocks you probably already hold. When a country with 1.4 billion people, the most populated country on Earth, commits to a $500 billion shopping list of American products, that shows up in earnings. That shows up in your portfolio. Actionable takeaway. Check your S&P 500 exposure in your 401k. It already includes many of these companies. This deal strengthens them. Do not panic trade. This is a reason to stay invested, and potentially add on dips. This is one of the moments where doing nothing smart is still doing something smart. Point 3. India is quietly replacing China in global supply chains, and that is a massive long-term investment thesis. Rich investors and hedge funds figured this out 2 years ago. Most Americans are still catching up. US companies spent the last decade trying to reduce their dependence on Chinese manufacturing. India is the biggest beneficiary of that shift. Lower labor costs, English-speaking workforce, a democratic government, and now, a trade deal with the United States. Actionable takeaway. Consider adding a small allocation, even 5 to 10% of your portfolio, in emerging market funds that are overweight India. Not because it is exciting, because it is diversification at the right time. Diversification is not just about protecting yourself from losses. It is about positioning yourself for gains that your current portfolio cannot access. Point 4. The pharmaceutical angle that almost no one is talking about. India produces roughly 40% of all generic drugs sold in the United States. The prescriptions you pick up at CVS or Walgreens, a massive portion of those come from Indian manufacturers. Under this trade deal, the US agreed to remove tariffs on generic pharmaceuticals from India once the full agreement is signed. That lowers costs for American consumers. It also strengthens the business case for Indian pharma companies. Actionable takeaway. Look at Indian pharmaceutical ADRs. that is, American depository receipts, which trade directly on U.S. exchanges. Companies like Dr. Reddy's trade under the ticker RDY. You can buy them like any U.S. stock. The medicine cabinet in your home is connected to this deal. That is how integrated these economies already are. Point 5. The risk most investors are ignoring. This deal is real, but it is not fully signed yet. As of March 2026, the formal legal agreement is still being finalized. The U.S. Supreme Court struck down parts of Trump's tariff framework in February 2026. The administration is rebuilding that structure. What that means for you: the tariff relief is happening at the border right now, but the full deal could shift, get delayed, or get renegotiated. Do not bet your entire portfolio on one outcome. Rich investors hedge. Most Americans concentrate. That difference, right there, explains a lot about why the wealth gap keeps growing. Actionable takeaway: invest in the theme, but size your position appropriately. A 5 to 10% allocation to India-focused assets is a smart diversification move. Going all in is speculation, not investing. The goal is to benefit from the upside without exposing yourself to a reversal. Objection handling. I know what you are thinking. International investing feels complicated. I don't know where to start. What if I pick the wrong thing? That is a fair concern, and here is the honest answer. You do not have to pick individual Indian stocks. You do not need a special account. You do not need to understand every detail of international tax law. A single India ETF in your existing Roth IRA or brokerage account, purchased the exact same way you would buy Apple or Microsoft, gives you broad exposure. That's it. That is the starting point. The complexity barrier is mostly in your head. The actual action is simple. Here is the bottom line. A $500 billion trade deal between the world's largest democracy and the most powerful economy on Earth just got announced. The tariff wall that was strangling Indian exports is coming down. American tech and energy companies gain a massive new buyer. And India, with 1.4 billion people and a 7% growth rate, just got friendlier to U.S. investors. The investors who act on structural shifts like this, before they are obvious, are the ones who build real wealth over time. Now I want to hear from you. Comment below with one word. What is your gut reaction to this deal? Bullish, skeptical, confused. Whatever it is, drop it below. I read every comment. And if this kind of breakdown is useful to you, the subscribe button is right there. I do this every week. No fluff, just the financial picture, explained clearly.